Welcome to First Intuition. Welcome to our business tax revision session. My name is Anne and I'm going to be taking you today through task number 8, which is about tax planning, and it tends to cover areas like the responsibilities of the business owner and of the tax practitioner. So this is going to be a written question, and of course written questions tend not to be everybody's favourite, but I do think it is important to make sure that you are confident with how to tackle these ones. So let's have a look at what task 8 is going to be about. Well, it's going to be 12 marks long, giving us about 14 minutes to complete it. And we have here a task briefing. If this is your first time joining a revision lecture, then just know that the task briefing is given as like a set of revision notes, if you like, just to set out a little bit of theory around this area, a bit of a recap for you before we get into the question. So if you'd like to pause the recording and read through that before we tackle the question, you can. If you'd just like to stick with me to do the question, and then maybe if you feel like you have a few gaps in your knowledge, go back to the task briefing, then that's also fine. So it is just a set of revision notes really, talking about some of the areas that the task may cover. You should practice plenty of written tasks. The examiner talks about this a lot. The only way to get better at a written task is to do more written tasks. So if you do have a tutor, then I would definitely suggest also contacting them to see if they will mark some of your written work for you. So here's our example of a task number 8 here then. It says you suspect that one of your clients is committing tax evasion. Now, the first thing I think there then is, oh, okay, that's that little section about tax avoidance, tax evasion and tax planning. So I've got to be quite clear in my mind that tax evasion is the illegal one. So we suspect one of our clients is committing tax evasion. That is illegal. Why do we think that? Because we've identified a number of items of private expenditure put through the sole trader's books, presumably as though they were business expenses. So explain the steps that we should take. Be very careful with this sort of question that we don't just launch in at the end without really thinking about the beginning, because there is a set procedure to follow here. So I'm just going to do this by way of bullet points because I just want to get the key facts across. In the assessment, you should be using full sentences. But I would suggest step number 1 is to establish the facts. So speak to the client, find out why the private expenditure is there, find out whether they appreciated that it shouldn't be there. Was this a genuine mistake? So speak to the client and get the full facts. That's why we're speaking to the client at all, to establish the facts, asking the client why they think this expenditure should be allowed and why they have included it as a business expense. If, having established the facts, we establish that actually it's not private expenditure at all, it is for the business, then everything is fine. If we do establish the facts and find out it is indeed private expenditure, then we'd have to advise our client to disclose the error to HMRC. So just to say, we've made a mistake, we didn't realise. So they've got a responsibility to let Revenue and Customs know, and then their accounts can be adjusted and any underpaid tax could then be paid. So assuming the client then says, okay, no problem, I will disclose my error, then we'd go down this route. So the client agrees to disclose. What would I do then? I just want them to know and to understand what the implications may be. So I would give advice on penalties and any interest that may be payable. But there's always a chance that the client will refuse to disclose, which creates us a little bit more work. So if our client refuses to disclose, I should firstly write to them, just to cover myself, to make it quite clear that there's no going back, and I just explain to them the consequences of failing to make a disclosure. So explain the consequences of refusing to disclose the error. Now, if I've gone down the first route here where the client has agreed to disclose and I've given advice on the penalties and the interest, the client then goes ahead and discloses and we all get on with our work. If the client refuses to disclose this error, then we've got a problem. So we've explained the consequences of refusing to disclose the error. Assuming they still don't agree to disclose, then we have to go to our next level, which would involve resigning. We would cease to act for the client. We can't act for a client that refuses to take our advice and refuses to comply with the HMRC legislation. We also inform HMRC that we have resigned. This is very, very important. That's all we say. We've resigned from the client. We don't give any indication as to why. We just say we have resigned. We can't give the reasons because it would be a breach of confidentiality. I would need to go on to consider whether this is a money laundering reporting offence. So I need to consider if I need to make a disclosure to the firm's money laundering reporting officer is required. Or in the case of a sole practitioner, it will be a disclosure directly to the National Crime Agency. If you are the money laundering reporting officer, then you go directly to the National Crime Agency and you file a suspicious activity report. In the case of thinking that there's tax evasion going on, so money laundering reporting officer or National Crime Agency. And then the last thing to think about would be, again, your client potentially has had you acting for them for a while. They then go out and get a new accountant, a new advisor, because you have now resigned. The new advisor might write to you to say, just out of professional courtesy, to let you know, this client used to be your client. They've asked us to work for them in future. Do you know of any professional reasons that we shouldn't take on this assignment? So you have to then carefully consider how you're going to reply to that letter. So carefully consider your response to a professional inquiry letter from the new advisor. Again, you mustn't breach any confidentiality, but you also mustn't tell lies. And there we go. So they would be the steps that I would suggest with any sort of question involving a client refusing possibly to make an error right. But notice we didn't just dive in. We said, firstly, establish the facts. We speak to the client, find out what's going on. Then we advise the client to disclose their error, which they may or may not do. And then I just take the examiner through the flow chart, if you like, of how I would proceed at each stage. So that would be the framework of my answer there. So of course you wouldn't lay it out like that in the exam, but I think that that helps us when we're just trying to revise what the steps are. Next one. Another one of your sole trader clients called Richard has also been in touch. He says, my friend Nigel says his accountant has managed to get him a tax refund because his business is making losses. Why am I working hard to make a profit if I end up paying tax on it? Would I be better off making losses as well? What an interesting strategy. It's for 2 marks here. So I think the first thing that I would say to Richard is that Richard needs to focus on his profits rather than the tax that he's paying. Making profits in a business is a good thing. So let's start by telling Richard profits are good for business. They demonstrate a successful business. Although the downside is there is tax to pay, of course, on profits. And the higher the profit, the more tax we pay. That is just how it works. I would say that Richard would definitely not be better off with a loss. Since a loss means the business is worth less than it was before. And I think maybe to help you understand this, just imagine you're at work and your boss comes to you and says, "Got great news for you, we're going to give you a pay rise." Lovely, you're going to earn more. Now by earning more, you're going to pay more tax. So what do you say to your boss? Do you say, "Well, thank you, but no thank you. I don't think I want the pay rise because I don't want to pay any more tax"? That would be a bit ridiculous, wouldn't it? Because you're turning away, let's say you pay tax at, just say, I don't know, 25%. So if you're paying 25% tax, then at least you're keeping the other 75%. Rather than just saying, "No, I don't want anything," rather have 75% of something than 100% of nothing. So definitely not better off with a loss. The loss means the business is worth less than before. And of course, it's not sustainable in the long term. The business can't survive making losses forever. Profits, even though they attract more tax, profits will always improve the after-tax income. So better to have profits, so better to be able to have and, let's say, and keep some profit rather than lose money. So only 2 marks, just wanted to make sufficient points that I feel that I've really explained it properly, and then we can leave that there. It's not a good planning strategy. Richard has been in touch again, so we've answered that one question for him. He's now got extra questions. Nigel says he only pays tax on the money he takes out of his company. On my tax return, I seem to be paying tax on my total business profits. Why can't I just be taxed on my drawings? I think that's a fair question from a client that doesn't understand the difference between a sole trader and a company. But that seems to be what's happening here. Nigel says he only pays tax on the money he takes out of his company. That's the thing, isn't it? Nigel has a company. So the difference here is between the tax treatment of dividends and drawings. So let's start by explaining. Richard is a sole trader. Nigel has a company. And they have different tax treatments. That's the first thing that I'm going to say. Let's think about the company then first, perhaps. So companies pay corporation tax on their profits. Whoops. So companies pay corporation tax on their profits. So although Nigel himself might feel that he's not paying the tax as such, it's Nigel's company, and his company is paying the tax on the profits that it makes. The dividends are then paid out of that after-tax profit, i.e. the profit already taxed. Remember, the profit is taxed with corporation tax, so when the dividends are then paid, the tax has already been paid on the profit. This is what's left. We're now just dishing out some of the profit that's left after the tax has been paid. The shareholder, so Nigel, then has to report the dividend on his personal tax return and pays income tax on that. So the shareholder Nigel includes the dividend on the personal tax return and pays income tax. So Nigel is strictly speaking right that he is only paying income tax on his dividend, but what he failed to mention to our client Richard is that the company that he's a shareholder of is paying tax, leaving less profit over to pay the dividend out of in the first place. The reason for this? Because the company and the shareholders are treated as separate legal entities. So the company and the shareholders are separate persons for tax and law purposes. Okay, it did say explain the difference in the treatment of dividends and drawings. We've talked a lot about dividends, we haven't really talked about drawings yet, so I'm just going to add something onto the end about this. A sole trader pays income tax and national insurance on the business profits. And then when the sole trader withdraws money from the business as drawings, because a sole trader can't take a salary, if a sole trader takes money out, then it's called drawings. So when the sole trader then withdraws the money from the business by way of drawings, those drawings are tax-free because they come from profits that have already been taxed. So there is definitely a difference in the treatment, and in terms of which one is better, well, it's usually assessed on a case-by-case basis. You'd look at the taxpayer's individual situation to see whether they would be financially better off as a company or whether they would be better off to stay as a sole trader. But we've done our job there by explaining the different treatment of the two things. So they were the 3 parts of task number 8, so I hope that was helpful. Feel free to join me for some other sessions. The next one, of course, will be task 9.